Do you know how the banks are being bailed out? It may surprise you. In this video, we will delve deep into the topic of bank bailouts and explore how they are actually being financed. Welcome to Simply Economics. Before we embark on this journey, be sure to subscribe to our channel and hit the notification bell so you never miss a second of the most up-to-date financial news. So, let's get started. The banking sector has been hit hard by the economic fallout of the pandemic, with some of the world's largest banks reporting big losses and capital deficits that need to be filled in order to continue operations. On March 2023, the dreaded downfall of Silicon Valley Bank and Signature Bank sent shockwaves throughout the financial world. As panic spread among customers, billions of dollars were withdrawn from these two institutions in a matter of days. Consequently, their stock prices suffered an unparalleled plummeting rate. This historic event became known as one of the most financially tumultuous collapses to date. In an unprecedented move, the government opted to pay for all of the failed banks' deposits, even those that exceeded federal insurance limits. This quickly drew ire from critics and was likened to another costly bailout in 2008 when taxpayers had to cover around $700 billion just so some big-name firms could be saved. Although both scenarios bear similarities, one major difference stands out. The reimbursement of deposits at SVB and Signature Bank was completed without a single dime coming from taxpayers. This has been emphasized by government officials such as President Joe Biden and Treasury Secretary Janet Yellen. As we continue with this video, let's understand what a bank bailout is, and I shall be providing a few examples of notable bank bailouts from the past. What is a bank bailout? When a business or organization is facing insolvency, they are often given financial aid in the form of cash or loans to prevent complete collapse. This type of support is known as a bailout and can be provided to banks, corporations, and other entities. Governments may opt to bail out a bank or business as an effort to safeguard the national economy from potential catastrophes, such as job losses and investment uncertainty. A bailout is often seen in a negative light due to its correlation with banks and companies that demand government assistance because of indulging in hazardous risk-taking. During the financial crisis between 2007 to 2008, as well as during the 80s and 90s savings and loan crises, hundreds of billions worth of taxpayers' funds were spent on bailing out various banking firms and organizations. Why the need for bailout? Although permitting a company to fail may appear like the ultimate solution, it is not always the preferred choice. There are various reasons why bailing out companies can be advantageous for both that particular organization and even our larger economy. Thus, one must consider all options before making a decision. Number 1. Job losses. When a business collapses, it can cause devastating consequences. Countless jobs may be destroyed, leading to diminished consumer expenditure and lessened government income. Furthermore, these setbacks will likely increase the pressure on already strained social safety net programs. Number 2. Economic instability. When a major corporation falls, it can create economic pandemonium, particularly if there are strong ties to other businesses or industries. This could then ensue in a domino effect of company collapses and further financial calamity. Number 3. Loss of investor confidence. Permitting a business to fail can not only undermine investor assurance, but also spark an overall lack of confidence in the stock market and monetary system. This, consequently, may make it harder for other entities to acquire capital, leading potentially to an economic downturn. And number 4, legal complications. The process of shutting down a business can be complicated and messy, particularly if the company is deep in debt or has extensive legal matters. These proceedings may drag on for long periods of time, costing both money and energy to resolve. Generally, companies are supported through bailouts or other forms of financial aid in order to avoid the potential necessity of allowing them to fail. Although it can be a despondent reality at times, permitting failure may be unavoidable for some businesses. What are the risks of bailouts? By bailing out a company, we may be allowing them to become careless with their investments and assume too much risk. Additionally, those who foot the bill, either taxpayers or other investors, could end up losing money without any potential reward in return. Such risks of moral hazard associated with bailouts must not go unrecognized. What are the terms of a bailout? Bailouts may be tailored to suit each individual case, but a company that receives one must typically abide by strict regulations. These can include changes in management or operational structure, as well as limits on executive pay and debt. The overall aim is to make sure the organization achieves fiscal stability without having to resort to additional government aid. Such conditions guarantee increased oversight and assurance of proper usage of funds, along with other accountability measures. What are some examples of bank bailouts? First, the 2007 to 2008 financial crisis. In the mid-2000s, during a particularly active period in U.S. housing market history, numerous high-risk mortgage loans were offered to low-income and credit-impaired homebuyers who lacked adequate information. Unfortunately, this lax approach resulted in an eventual subprime crisis by 2007, as many of these loan providers began filing for bankruptcy due to having little or no buyers for their mortgages. The subprime lending activities of Lehman Brothers and Bear Stearns eventually led to their demise, causing U.S. housing prices to plummet drastically and leaving millions of property owners with mortgages that surpassed the worth of their homes. The Great Recession, a depressing economic downturn that stretched from December 2007 to June 2009, was triggered by these events. To mitigate the damage and preserve troubled banks and other companies in jeopardy, the federal government took action in 2008 by establishing the Troubled Asset Relief Program, or TARP, a $700 billion stimulus package. Applying $245 billion of taxpayer money, the TARP plan bolstered more than 700 financial institutions. The government acquired preferred stock in several at-risk banks such as Bank of America, Citigroup, Goldman Sachs, J.P. Morgan Chase & Company, Morgan Stanley, and Wells Fargo, to name a few, including Bank of NY Mellon and State Street Bank too. The majority of investments have been resolved successfully, and the government even managed to gain a profit from them. The second example, savings and loan crisis. Commonly referred to as thrifts, savings and loan associations, or S&Ls, primarily focus on loaning out money for residential buildings, usually situated in their own neighborhoods. Sadly, several of the S&Ls throughout America failed during the 1980s and 1990s due to them investing a lot of funds into high-risk junk bonds alongside double-digit inflation's crushing consequences. In the 1980s, legislation that limited S&L's ability to impose interest rates on deposits and loans caused depositors to look for other banks with higher returns. During this time of recession, fewer consumers were taking out mortgages, meaning these smaller S&Ls weren't able to remain profitable from their small number of low-interest mortgage applications alone. Consequently, the United States Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. This law gave rise to the Resolution Trust Corporation, which was tasked with closing down hundreds of failed savings and loan companies while also generating funds necessary to pay back their depositors in full. Unfortunately for taxpayers, this bailout ended up costing a grand total of $132 billion. What about the SVB and Signature Bank? Were they bailed out? Politicians, regulators, and analysts have argued that the Treasury Department's effort to protect depositors of Silicon Valley Bank and Signature Bank is not a bailout, since it does not use taxpayers' money. The Deposit Insurance Fund does not rely on taxpayer money. Instead, it is funded by the fees that banks pay into this fund. Moreover, neither shareholders nor unsecured debt holders will be given protection under this plan, meaning no burden to taxpayers whatsoever. On March 13th, President Joe Biden addressed a televised audience to make it absolutely clear that the government's actions towards the two failing banks in no way constitute a bailout. He confidently declared that taxpayers would remain unscathed by any losses. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Biden said investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. While testifying in front of the Senate Finance Committee on March 16th, Yellen mirrored the president's sentiments and asserted that financial institutions bear the responsibility for depositing funds to cover deposits at two collapsed banks. On March 12th, the FDIC, Federal Reserve and Treasury Department reassured depositors at both failed banks their funds were safe. Additionally, they made it clear that no taxpayer money was being used to cover costs, and shareholders and certain unsecured debt holders may not be reimbursed. If the Deposit Insurance Fund sustains any losses in defending uninsured depositors of a failed bank, those costs will be absorbed by banks through a special assessment fee, as clarified in the regulator's statement. Here, the regulatory body proclaimed that the Federal Reserve would grant banks enduring access to funds by providing one-year loans through a novel Bank Term Funding Program, or the BFP, should their cash flow become constrained. The resolution of the Silicon Valley Bank and Signature Bank's failure is a testament to the strength of our financial system. Thankfully, no taxpayer money was used in defending uninsured depositors, and the banks themselves will absorb any losses incurred by their failure. Hopefully, this incident further reinforces Americans' faith in their banking system. At its core, it shows the resilience and efficacy of our government's policies in providing relief to those affected by economic hardship. We can only hope that these measures are enough to prevent any further collapses of financial institutions going forward. Be sure to subscribe to Simply Economics for more in-depth analyses of economic trends, policies, and news.